problems related to stock valuation. And
Uh-huh.
one of that problem is related to the dividend discount model. We'll be using that one. And the next one is the discounted cash flows. And these are problem 2 and 3 in your assignment.
Yes,
Um,
sir.
yeah, homework 9 assignments. So let's break it down and see what the problem is and how we can tackle the issue. So you're considering, this is the problem, you're considering an investment in Justice Corporation stock, which is expected to pay a dividend of $3 a share at the end of the year. So that means this is the next dividend. That is the end of this year. So if you buy it right now, you will be receiving that dividend. So in other words, that is our D1. So that is the next dividend, and we call it the D1 in our formula, and it is equal to $3. So we note that down, no big deal. N has a beta of zero point 0.9. Okay, so they're giving additional information. We're not yet sure why are they giving that information, but let's note it down. We may
Mm-hmm.
need it. So the beta of this company is zero point 0.9. I wrote that down. The risk-free rate is 2.6%. So when you get this kind of information and you're already familiar with the CAPM equation, it kind of gives you an idea like, hey, we might be needing that CAPM equation to solve something. Anyway, we're going to write it down. The risk-free rate, which we call RRF, that is 2.6%. And the market risk premium is 5.5%. So I also note that down, market risk premium. And remember that market risk premium is actually equal to the RM, which is the market return, minus the RF, which is the risk-free rate. So the difference between the two is the market risk premium. We call that RPM in this case, in short, and it is 5.5%.
Mm-hmm.
And they also tell us that the stock currently sells at $42. So that means this is the current price. So we know the current stock price, and we call that P0 in the formula, and that is $42. Assuming that the market is in equilibrium, what does the market believe will be the stock price at the end of uh,
3 years.
3 years? Okay, so um, we have got 3 years, and what we have got the current price. Now it becomes quite simple if we have the information. We can use this formula. P3 would be equal to P1 multiplied by 1 plus the growth in the dividend, and which is also the same as the growth in the stock price, raised to the power to the number of years where we want to find the price. So we can use this formula to find P3. So that's pretty simple. However, when we look at the variables, we have got P1, but we don't have the G. We don't have the growth rate given, right?
Right.
So the constant growth, and they also tell us that the stock will grow at a constant rate, a certain constant, but that is not given to us. So there's the problem. We need to find the G in order to solve this equation. Okay, so what formula can we use to find G? We can use this formula, which is the dividend discount model. P0 is equal to D1 divided by RS minus G. Um, but again, here we don't have the RS as well. So
Mm-hmm.
this is it is like, you can see like a serial problem we have got. We need this equation. For this we need the G, which is not given, and in order to calculate G we need this formula, but in that case the RS is not given. So first we need to find RS, and we have enough information to find RS, or the cost, the required rate of return on the stock. We can use the CAPM equation. Can you recall the CAPM equation? That was equal to, the equation was R is equal to RF, the risk-free rate, plus uh, we start the parenthesis, and then the market risk premium, which we write is RM minus R RF. So that difference is the market risk premium, and then we multiply this with the beta. Okay, that is the formula that we can use to find the required rate of return on the stock. So let's use this formula right
Mm-hmm.
here and calculate that discount rate or the required rate of return. We can
Mm-hmm.
also call this the required rate return. So we have all the data for this, all the variables. So that is equal to, let's start with the RRF, which is the risk-free rate, 2.6% given to us, plus
Mm-hmm.
um, this RM minus RRF, which is the
Market rate
market risk
premium.
premium that is also given to us as a whole. So that is 5.5% and then
Mm-hmm.
multiplied by the beta, which is 0.9. So we got that one. Now, when we have the required rate of return on the stock, we can use all the data to find the growth rate. So let's go there and find the G. Now, here's the formula for calculating the growth rate. We can use this for P0 is equal to D1 divided by RS minus G. But we have to rearrange this formula in order to calculate, to find G, right? And that
Right.
rearranging will make the formula something like this. I hope you can rework that, um, algebra and rearrange the equation, right?
Right.
Um, it should not be any problem. But if you want to, we can go through it right here. If you want me to rearrange this for you.
Yes, sir.
Okay, let's do it. So let me pull out my paint. Okay, so the formula that we have is something like this. We have P0 is equal to D1, which is the next dividend, divided by R minus G. Okay, we have to find G, so let me take this to the other side of the equation. So it goes to the other side multiplied with P0, and P0 goes to the division to the other side of the equation. So that becomes D1 divided by P0,
P0.
right? Okay.
Right.
Now, if I take this G to the other side of the equation, that sorry, R to the other side of the equation, so that will be minus G is equal to D1 divided by P0 and minus R. But we need a positive G, right? So we multiply this with the whole equation with a negative. So if we multiply this minus G with a negative, it becomes a positive, right?
Right.
And this is positive, so that will become negative, and R will become positive, right?
Right.
So, in other words, the equation would become something like this. G is equal to, because R is positive, so I write that first, and sorry, G is negative, so D1 by P0 is negative, so I take it to the other side, minus D1 divided by P0. So we will be using this formula to find G. So it is actually a rearrangement of the dividend discount model. We simply rearrange it to find the unknown variable. Make sense now?
Yes, sir. And then that D1 is going to be the $3 divided by the number per share, which was $3 divided by 42.
Exactly, exactly. That's right.
Okay.
Okay, so let's do it. All right. So, and here I have written it down for you. So G is equal to R divided minus D1 divided by P0. So which
Mm-hmm.
is something that we just derived. So equals to R, which is the RS, basically the required rate of return on the stock, 7.55% minus D1, which is $3. Okay, and divided by P0, which is $42 right here. Okay,
Mm-hmm.
so the growth comes out to be 0.041%.
Mm-hmm.
Okay, That comes out to be a very nominal growth, very small growth. But anyway, let's see what we get. Now we can calculate that we can use this formula to find P3, and we have all the information. So equals to um, we use P0, which is 42 multiplied by bracket start 1 plus the growth rate, 1 plus the growth rate, which is 0.41%, and close the parenthesis. This is raised to the power 3 because we want to find that price after 3 years. Okay, so that comes out to be 42.52. So that will be the P3. You can enter this information right here in that form, and you will get the answer. Now you see that the price difference is very little. The current price is $42, and after 3 years, it is expected to be 42.52, like $0.50 increase in 3 years. But the thing is that the growth rate is very small in this case. So it doesn't matter what we get, but that's what it is. All right.
Okay. Yes, sir. I think what I probably did on my problem, I think I might have I might have got confused watching the video, and I might have put in the wrong value, because when I did it, I came up to $40.40, but then when they confirmed it, it was like a cent higher than it was when they worked out the original problem. So I got it wrong. So I checked it again. I said, well, maybe I might have been off a cent. I did again. I got it wrong. So then what I did, I completely did it over again. And then on my second problem, I ended up with $36.12. I have yet to check it because I'm on my last time.
Yeah, yeah. Sometimes that you know everything, but let's say like just for you click the wrong button or just give it the wrong information, wrong value. Like instead of the growth rate, if you give it the discount rate, like you didn't mean that, but by the time you find the problem, it would have already exhausted you. So anyway, that is how it would work. So in order to calculate P3, we need G. So we've got first calculate but in order to calculate G, we need R. So we go in the reverse direction. You first calculate R, then G, and then we use that information to find P3.
Okay.
All right.
All right.
Okay, now let's jump to the next one. And this is basically the discounted cash flows model. So this company is a fast-growing supplier of office products. Analysts project the following free cash flows. So they gave this data right here in a table, but I just pasted that data right here. Okay, so this number was not given. So they were given like minus 15, and if these numbers are in millions, so this will be minus 15 million and 22 million and 15 million, whatever. Okay, and so those were the cash flows for the next 3 years, after which free cash flows is expected to grow at a constant rate of 6%. So that constant growth, long-term growth is 6%, but that is after 3 years from this point onward. So which means the next cash flow would be equal to the previous cash flow multiplied by bracket start 1 plus the growth rate, which is 6%, right?
Right.
And raised to the power 1 in this case, because we are just compounding it, the previous cash flow to the next one. So the next cash flow would be 53. And if you would like to find the rest, so you can drag it, but that continues. Okay. So the problem here is that I am giving a reference to this growth rate, and I need to make that to put those dollar signs so that when I drag the cell to the right or whatever, that reference does not change, you see. So the year at cash flow would be $67. Okay. Uh, all right. So the WACC for this company, weighted average cost of capital, is 15%. So I have noted that down. WACC is 15%. There's three questions that we need to answer. What is the this company's horizon value or continuing value? What we mean by that, the horizon value, if you can recall from our previous lecture, is the value of the stock from the point onward where it becomes a constant growth stock. And where's that point? That point is starts from year 3 to year 4. From year 3 to year 4, there is a 6% growth, and that growth is constant forever. So we will have to calculate the horizon value at this point. And what we need to use is basically the dividend discount model. So just think about that next cash flow is the next dividend, and the rest of the variables are the same. Okay, so in order to calculate that value, the horizon value, it will be equal to D1, which is the next dividend. In this case, this is the next cash flow. Just, just to make it easy to understand, think about it as the next dividend. So that is the next cash flow divided by RS minus G, or R minus G. Remember that we need to put this in parentheses because we need that to find that difference first. So parentheses start RS, or WACC. In this case, we use the WACC, weighted average cost of capital, or the discount rate that we use here in this problem,
Mm-hmm.
and minus G, which is 6%. So, and then I close the parentheses, and I got that horizon value. So we got that answer. Okay.
Mm-hmm.
And here it also gives you the hints, like you have to, even though these numbers are in millions, but just put that in millions because this is already in millions. So we will have to enter this as 588.89, and that's it. It will give you the correct answer. Um, and then we got the horizon value, so that is one thing that was required to be calculated. The next question: what is the firm's market value today? So what is the firm's market value? And for that, we need to use the corporate valuation model, and the equation is here. Market value of equity, which is the same as the market value of the firm, is equal to the market value of operations. Okay, plus the market value of non-operating assets. In this case, they have not given us any non-operating assets, so we give that as a 0. And market value of debt and preferred stock. Okay, preferred stock. And that is also not given, so we take both of those values as 0, assuming that there is no preferred stock and there's no debt. So in order to calculate the market value, we need to find the present value of all of these cash flows. So what is the total cash flow that we will be getting if we buy this firm? Next year, we will receive, or we will have to pay $15 million. Those will be, additional cash outflow from us.
Mm-hmm.
And then in year 2, we will receive $22 million. But in year 3, we will be receiving the $50 million cash flow. And plus, if we want to find we have already found the horizon value of this firm for the future cash flows, which is equal to 588.89 million. So just imagine as if we are going to sell this company at this point. So we'll be receiving that cash flow plus the horizon value of the company, and that will be the total cash flow that we receive. Okay.
Okay.
In order to find the present value of the company, we have to discount all of these cash flows. Okay, because these are taking place in the future. So let's use our formula, equals to a future value. The present value formula is equal to future value. So for the first one, it is minus 15 million divided by 1 plus R, which is the discount rate, and discount rate for this company is 15%.
WACC.
Exactly, WACC. And let me put those dollar signs over here because I'll be dragging it and I don't want that reference to. That WACC is going to be the same for all. So that is minus 13 million. And okay, I also need the number of years. So raised to the number of periods
One.
for which we want to. That is 1. Correct. And then
Correct.
we drag it to the right, and we get all of those discounted cash flows. So for example, for the second one, we're using the same WACC, but we're using the next cash flow, which is $22 million, and we're using the next number of years, which is 2. And for the third one, it goes like that. Then the final cash flow, which includes the horizon value plus the cash flow at that time, and the 3 years discounted at 15%. Now, these are the individual present values of the future cash flows. The market value of this market value of operations, or the market value of this company, would be, because they have not given us any bond or debt, so that would be equal to uh, the market value of operations. So it would be the sum of the present values of the future cash flows. Make sense? That is the market value of operations. Okay, now what will be the market value of equity? In this case, market value of equity is the same as the market value of operations because we don't have any debt in preferred stock. But if we had any, then the total market value of equity would be equal to the market value of operations plus the market value of non-operating assets, which is 0 in this case, and minus the market value of debt, which is 0. But if we were given those numbers, it would be that one. So in this case, because we don't have the debt and asset, the market value is the same as the market value of equity is the same as the market value of operations. Okay. And if we had to find the price per share, the value per share, in that case, it would be, we're given like in the next problem. In the next problem, they've given us what if this company has $42.4 million of debts. So if in case you construct this model, okay, and you have to then do the next question. You already got answer to your question number 2, so you can write it down over there, and it will give you the correct answer. Because if we change the numbers, like for example, if I add the debt right here, my values are going to change because these are all connected. So 42.4, okay. And that is my next value. And what else is given? And 29 million shares. So we have got 29 million shares. Number of shares are 29 million, right?
Million. Uh-huh.
They still don't talk about any non-operating assets. So that means the non-operating assets are still 0. Okay. So we've got this value, and the price per share would be equal to the market value of equity divided by the number of shares, which is 29. Because all of these numbers are in millions, so this, the market value of equity is also in million, and the number of shares is also in millions. So those zeros cancel each other out, and the market value per share will be $13.15. So that is how it is. Is there any question, any problem that I can explain further?
Okay, the 420. Can you do that that last part one more time?
Sure.
About it, yeah.
Oh, okay. So in the first question, they had not talked about any debt or non-current assets. So those numbers are 0. And they also did not ask us in question 2, they did not ask us to calculate the market price per share. So this number is not required in question 2. What they are requiring in question 2 is the firm's market value today, right? So the market value in that case would be this number, 423.67, because it does not have any debt or any non-operating assets. So this number 423.67 is your answer to question number 2. If you're
Okay.
solving this, so you got this one, you take this and enter it in your assignment, and you got that done. Because if you change, because for the next question, we need to change some of these numbers. Like, for example, there is a debt, which is 42.4 million. So 42.4, when I put that, it changes my values. Or if you don't want to do it this way, what you can do, let me copy this whole thing,
Mhm.
in just to avoid that confusion. Control C, and I will paste it right here. So all those things are the same. The only thing that I want to make different is I'm adding, in the previous question, there is no debt and no non-current assets. Here I'm adding the debt, 42.2
0.4.
million, 0.4, 42.4. And you see the share price is now different. So just in case, all the values are going to be this value is different and that value is different. So you can see, like, when we had no debt, all the cash flows are the same. Those cash flows in the previous scenario and in this scenario, those are the same cash flows. We're still doing the same business, exactly same customer sales, same sales and expenses. But the only thing that is different is that in the previous example, we did not have any debt. And for that reason, the market value was higher. But when we introduce debt, the market value per share goes down a little bit because now we have debt and that has to be repaid before we can find the value of the stock. So we take that debt's value out in order to value the company.
Okay.
Make
Okay.
sense?
Yes, sir. Yes, sir. Yeah, because I believe like the first two, it might have been a rounding issue or a plotting issue, but that second one, for my problem, I entered it the way that I had,
Mhm.
and it was wrong. So,
Okay. All
so
right.
yeah. So I
So
might have to,
you're
yeah.
clear. You're clear now, right?
I'm clear. Yeah, I'm clear. I just got to figure out, where I messed up at. But yeah, for the most part, I'm clear.
All right, that sounds good. And by the way, I have also extended the deadline for the assignment for you. So it is due next Wednesday because some students had technical issues with the website and could not submit it on time. So I gave that extension to all the students. So you have time to practice this and then complete your assignment.
Okay.
Anything else?
No, sir. That was it.
All right. Okay, Anthony. So that was great to talk to you and go through the problems. If there's any other issue, just send me an email and we'll sit together to discuss it. All right.
Okay. All righty.
Okay, take care and have a good evening.
Oh, you too.
All right. Thanks. Bye bye.
All right. Bye bye.